Hey everyone, it's Larry Berman here, and what a start to the month of October. As you could see, I've done nothing else this week but eat, sleep, and trade. Volatility in markets has certainly picked up, and key technical levels we've talked about over the past few weeks were really tested today. So let's have a look at the chart room and see what we learned and didn't learn this week. So looking at economic calendar, as we often do, and some data that came in this week, obviously the non-farm payroll report was shockingly monstrous in terms of the headline number. Now, the household survey was less robust by a long shot, but nevertheless, there was good breadth in job growth in general. And the narrative that after the initial shock of the number, the narrative that percolated through Wall Street, whether it came from ex-Fed governors or pretty senior economist Mohamed El-Erian, for example, that opined on financial TV, that these numbers for now are really good, but the stronger the labor market remains, of course, the higher for longer message needs to get pounded home. But the earnings and the wages were on the soft side, and that's really what the market liked. And so the narrative that developed on Friday was, well, we got great. All these people are getting jobs, and that's terrific. And you know what? Inflation pressures are coming down because the wages aren't there. To me, it's mind-numbing that the optimists will always try to find something good in the data, and the pessimists will always try to find something bad in the data. Overall, you had to like the report. And so what does that really mean for markets? Not trying to paint it one way or the other. And many will opine that Berman's a bear, and Berman isn't a bear. Berman looks at risk, and I always say at first I'm a risk manager before anything else. So I consider the worst case scenarios, and when you look at history and you think about what the Fed's done in the last year and a half and how aggressive they've been, not to think that we will get a hard landing out of this seems an insane thought, but there are those out there that, are saying that the soft landing's still likely. Is it possible? Yes. Is it probable? Unlikely. Having said all that, when we further unpack the data, as we look forward, we see that PPI and CPI are coming up this week, and we are expecting somewhat benign numbers relative to last month, i.e. a slight downtick. So will the market like that? Will it see it as really positive? What happens if it comes in lower? What does it mean in the scope of the dysfunctional U.S. governments? What did we learn? We learned this week that politics in Washington is beyond broken. We learned this week that possibly the guy who might lead Congress is, well, I don't want to get into it. So we'll see how that all goes, but underscoring the real mess that complicates the budgeting process, the bipartisan nature that's needed to get the economy through what's likely to be a very difficult couple of years. And to think the idea of all this reshoring and onshoring that's causing this massive demand for employment is not going to lead to sticky inflation on the wage side seems to me to be somewhat naive. Anyways, let's look at the Canadian picture. I've waxed on and off about that. So on the Canadian side, again, a smoking hot total job number, a downtick in the unemployment rate, where most of the jobs came in the part-time component. So Again, from the Canadian perspective, leaving on the table the idea of rate hikes down the road. And when we look at the probability of rate hikes down the road, we see that, there's still an uptick after the data in that, but by no means a certainty. I don't believe either central bank needs to raise rates again. I do believe the higher for longer will moderate the economic momentum in due course. And the only question is, when does that going to happen before we hit a hard landing and before they have to tighten? We heard from a lot of Fed speakers this week, and a leak through Nick Timiraos, which is a known Fed portal in the Wall Street Journal, basically saying that the long bond yields rising has been significantly tightening financial conditions. And that is very true as how they measure financial conditions. We're back and getting closer to some of the extremes that we've seen, say, in the last 5 years in terms of tighter financial conditions. So that should put the brakes on the economy, should help. Do they need to do more? Well, we'll see if we get another monster payroll number in November, or even a strong payroll number in November. That rate hike is probably on the table. When we look at the shock that hit the marketplace, we saw U.S. long bonds, and we're looking at yields here, jump 15 basis points within minutes, only to rally back the whole day as the narrative of soft landing and Goldilocks and everything being perfect, and then waking up to the reality that, oh, wait a second, we still have trillions of new debt coming, and oh yeah, we gotta pay for that somehow, and so bond yields start pushing higher. Eventually, equity markets really get the message. Today, clearly they didn't. So when we look at the futures market, so this is E-mini futures front month, looking at support and the 4,200 level we talked about being really important. You had the Fibonacci retracement, you had the 200-day moving average. And so if we look at the also the support from this trend line here, we can see why the market has been holding this 4,200 level. And so it did again on Friday. So that drove some short covering, and I can't see it being any more than that as we wind out the week here. So as we look at entering earnings season, trailing earnings again on the S&P 500, about $220. Forward-based earnings just under 218. This is forward 12 months. If we look out through the end of next year, we get a slightly higher number. Are we going to see a multiple expansion? Because that's what you need from this point on, with the market already trading at about 20 times forward earnings. And to me, that answers a hard no, that they're going to be able to skate through this thing with a soft landing. So again, I'm looking at some point for earnings to come down a little bit. I'm looking for the multiple to come down a bit. And ultimately, this support here that we've seen this week, for lots of good technical reasons, ultimately doesn't hold. When we do our deep dive and see what has been performing worst on the S&P 500, we see some interest rate sensitivity. We see some, next era. We see these clean energy producers. We actually, with oil prices coming off significantly in the last week, we see some pressure on some energy names. ExxonMobil, you'll probably have heard they offered to buy another company, and that put some pressure on Exxon on Friday. But ultimately, Boston Properties, so real estate, Domino's Pizza, Mondelez. We heard a lot of chatter this week from, Walmart and Costco and others, saying that because of these miracle drugs that I've been a great beneficiary of, Ozempic to control blood sugar, and ultimately, again, one of the very great byproducts of it is it makes you less hungry, is that people are changing their eating habits. So, where businesses have a big market share in munchies. We saw the soft drink makers come down, the Cokes, the Pepsis, the chips. People are eating less of it because they're less hungry. We heard from the airlines, and the airlines basically said, wow, our plane load weights are coming down, and we're attributing it to these diet drugs where people are losing weight. And that, of course, spun a whole bunch of other controversial discussion. But nevertheless, Eli Lilly and Novo Nordisk are the two primary drug companies that are the winners here. Novo Nordisk trades on the Copenhagen Exchange in Denmark, and it has a US ADR under the ticker NVO. It's a name we've traded in and out several times over the last few years. I first bought it, as I saw the benefits of the drug. I bought and sold it a couple of times already. And so the analysts think this stock's pretty fully priced here, given the price targets, but they've been chasing this thing up the whole way. And I don't think the analysts really understand how big this market is for these drugs. You read some of the reports and they talk about billions. My healthcare doctor that got me onto Novo talked about the size, what he thought the size of this market, and the efficacy of these drugs being so powerful for many or most people, not everybody, who gets on them. It's a dynamic, I would like to say, equivalent to artificial intelligence in terms of productivity, what this could potentially do to healthcare costs in the future. And so benefits to insurance companies, less cardiovascular disease, less diabetes, less heart and stroke issues, and ultimately going to lead to better outcomes. So question is, do you want to participate in that? And right now it's pretty fully valued. So, names like this are just buy them on a dip and write options on them, that kind of thing. So again, pretty excited about that. I'll bring out the just the NVO here just so you can just see the chart of it. And you can see just on every opportunity, there's been a couple earnings misses. The last one was a little bit of a miss. But at the end of the day, these things are not trading cheap by any stretch of the imagination. But the potential here just remains, incredible. So that's it for this week. Have a great one, everybody. As for the markets, again, caution still be the message. And while we bounced off this key support and we may hold for a week or two here into earnings, if the inflation numbers this week are on the hot side, and if companies come out and tell us they're a little bit worried about the go forward, then that support doesn't break. And we've talked about that next area of support being around 38 or 3,900 on the S&P, which would wipe out the gains for the year.